All right, everyone, and thank you, David, for having me. I always enjoy these events and speaking and being asked to present. We've got something a little bit unique, a little bit unusual, you've probably never seen before, automated options trading and our one-touch responsive trade alerts. So we're going to look at a demo of that. Our proprietary algo will pre-build option spreads for you and then also manage the risk and profit along the way as it monitors your account. So you don't have to screen watch and be glued to your chair. People really love that aspect about what we're doing. And then we also have a back testing engine. So you can go backwards in time and look at the results of any particular option spread. And then I think what really sets this apart is we are real people talking to other real people just like yourselves, and we're licensed and experienced, having decades of experience doing this, and that's all part of what we're going to talk about as well. But remember, we're speculating and we always accept risk when we try to make a profit. So do take a moment and look at that risk disclosure. It's a big eyeful there, I know, but go ahead and maybe take a screenshot of that or a picture or image if you want to read every word. The main thing here would be that you should always use risk capital when trading. There's always a risk of loss when trading, and that past performance is never a guarantee of future results. A little bit about AltaVest. We've been doing futures trading since 1997 as a registered introducing brokerage firm, and we've traded millions and millions of contracts along the way. That's the S&P 500 options trading pit. Some of our brokers and floor traders that worked for us over the years. Of course, everything is electronic these days. And we are the creator of a Dragonfly option strategy and our proprietary order execution technology. And clients have traded with us probably tens and tens of millions of options contracts using our solutions along the way. We're registered with the CFTC and a member of the NFA, so that means we are in a regulated space, and that's for your protection. And we're located in California. A little bit about myself. I am Erik Gebhard, been registered since 1991. I graduated from the University of Southern California. I have my BS in Business Administration, co-founder of AltaVest. I was also in the securities industry for a while with my Series 6 and 63 licenses. Currently have my Series 3 commodity futures license, as well as the Series 65 securities license, and that's for investment advisors. All right, we're going to jump in here. Let's talk about what we're not trying to accomplish. First of all, the way we do things, this is not going to be your trading competition. This is not something you're going to need to do what we're doing. In fact, I think this sort of gets overlooked oftentimes. We have this idea that when we're trading, this might be someone who's on the other end of our trades. This is actually who's on the other end of your trades, machines. So that's your competition. Automation, built-in risk and reward controls, whether it's HFT, machine learning, algos, large institutional order flows. A lot of it is just non-emotional. Some of it is passive flows as well. But really, it's systematic trading. And JP Morgan estimates 90% of US equity trading volume is systematic. So we like to kind of keep that in mind because it sort of puts things in perspective when we're trading options. So how can we use that type of approach when we're trading options in a professional manner? Can we trade options using automation and machines and do it in a competitive way? And the answer is yes, we think you can. And we're going to look at this like a large institution might trade options. And we know, for example, here's an analogy you could use, like an insurance company. And how do they trade options? Well, they might trade options the same way they operate their business. They get paid premiums to assume risk. They sell and manage time. They insure themselves with reinsurance. That's called a hedge in the trading parlance. And then they're consistent and they're patient in their process. And they're using a lot of math, essentially probabilities and favorable long-term odds. So a lot of statistics and actuarials and so on and so forth. And that's how an insurance company will tend to operate, just crunching the numbers, hoping that the odds are forever in their favor. So why don't we try to collect premium too? And yes, we can do that with option strategies where you collect premium. We're going to manage our risk and reward and not get greedy along the way. We're going to need some people to help us along the way as well, some coaching, some mentors. And just as important, you need the correct tools to automate this. And we're going to look for lots of base hits and not necessarily going for grand slams, for the most part, I should say. It's not the only thing we do is collecting premium. Of course, as a brokerage firm, we can trade anything, but what I'm going to show you today was designed around collecting premium and selling spreads. But also, of course, I'll show you, you can also buy options and spreads and do debit spreads just as easily as a credit spread. But we're going to look at short option strategies where you collect premium. And these can be non-directional strategies or bullish or bearish in nature. And we're targeting outcomes with fixed risk in advance. So these are always covered spreads. We're not doing any naked option strategies. And before we jump into the demo, let's learn a few Greek letters in the Greek alphabet. The first one has to do with probabilities, and that's delta. And the real simple explanation for delta is how much does the option value change with the change in the underlying asset? And that's the delta, but it's also the approximate probability of that option expiring in the money. So that's how traders look at delta. So a simple example, if an option delta is at 0.25, that means there's a 25% chance it expires in the money, but conversely, a 75% chance that it would expire worthless. So remember, delta is always moving with price and time. It's not a static number. And it is not the probability of a winning trade. So let's not lose track of what delta is useful for. And then theta is the other Greek letter here we're going to look at, and that's in reference to time. And it really means time decay. That's a measure of time decay with an option. Of course, every option has limited lifespan. There's always an expiration date. So it's a negative number equals 1 day of time decay when we refer to theta. So if an option's at 10 points, theta might be negative 0.05. So that means the next day the premium would drop to 9.95, and the next day after that 9.90, so on and so forth. And that's just assuming all other things remain equal. This is just a function of time is what I'm illustrating here. And this graph gives an overview. So as you approach time 0, you'll see the percent of the premium remaining here drops and drops and drops, of course, until it ends up with no time at all. So the Wall Street pros and the veteran traders and the successful, longer run traders using options, they're going to trade multi-leg option spreads, and they're going to collect premium. That's going to be really the focus of how they trade options. And here's this woman on CNBC. I have her, the link referenced a few slides later, and we'll show you. But she says an option spread is buying and selling different contracts, a common way for investors to hedge risk and volatility. And it's usually cheaper because you can offset your cost by the proceeds from different contracts. And it's been used by Wall Street professionals for decades. So she's absolutely correct. And here's a real simple example on an E-mini S&P 500 call spread. This is a strategy you might use if you're bearish or even moderately bullish, or if you're simply non-directional in nature. And here's what it would look like on a graph. As an example, you sell the 6410 call, that's the red line, and you buy the 6430 call, that's the blue line. You do it simultaneously as one order, and the net result is you collect 2.25 points in this example, or $112.50, and you put that in your pocket, of course, taking into account your commissions. But that's the idea. You sell an option, you buy an option to cover it, but the net result is you collect premium. And then you can see the market's kind of chopping around here, drops a little bit, and then you can see at this point I have a vertical line, and it just turns out that that would be the price where, or the place or the time where our software would tell you to close out that position and take your profits in this case and move on to another trade. You can see the expiration date here on the end. So here's another example where you might just sell a put spread, just the inverse of what we looked at. So that might be a bullish or moderately bearish or even non-directional approach. And just the opposite, you sell the red line, you buy the blue line, and you do it simultaneously as one order at one net figure, in this case 2 points. And you can see here, even though the market starts to drop and even drop further, it doesn't really matter because it's still these options that you sold and bought are still deep out of the money, and you would have a chance to get out of that spread and move on to the next trade. So here's an example of an iron condor, and that's a non-directional strategy for premium collection. It's just a combination of the bull put and the bear call spread that we just saw. And here's what it would look like on a graph. And again, you do this as one order simultaneously. So you place an order here to sell a 6410 call and buy a 6430 call, and simultaneously sell a 5420 put and 5400 put. And the net result is you collect premium on the call side of the trade as well as the put side of the trade. And then you look for the market, in this case, being a non-directional strategy, you hope it stays within these boundaries here, generally speaking, between the red lines. And you can see in this example, it does. And then here's what happens after time ticks away and theta decay works its magic. You can see right here where I have the arrow and this blue dot. That's a signal from our solution here, and I'm going to show you that. You can see here it turns blue, something called the RTI. That's called the risk thermal indicator, and I'll show you in a demo. So with 29 days till expiration, you place the trade here, market chops around, and then you close it out here by buying it back. So you sell high, and then over time you buy low. And that's the whole gist of these premium collection strategies. And here's the dragonfly. It's a six-legged spread, and it's also to collect premium, and it's really a variation on the iron condor, and it's a proprietary strategy we came up with years ago and then built the technology to handle it. And actually, I've never seen any other brokerage firm be able to handle a six-legged spread as one order, and we're going to talk about that in just a minute. But here's what the dragonfly would look like. It looks a little busy, I know, and you might be thinking, gosh, this is getting kind of out of control, but I'll show you how the software makes it very user-friendly and simple. But you're essentially selling 4 calls. You simultaneously buy 3 further out of the money calls, and then 1 closer to the money call. And you have the same structure with the puts. You sell 4 puts, you buy 3 further out, and then 1 closer to the money. And that would be for 1 dragonfly. If you want to do 2 dragonflies, then you'd be selling 4 calls and 8 calls and 8 puts. If you wanted to do 3 dragonflies, of course, you'd be doing 12 calls and 12 puts. Everything would move up, by a factor of 4 in this case. But the whole idea is the same thing. You end up with these calls here and these puts here collecting net premium. And let's take a look here. After theta decay, what happens? Market kind of chops around, and over time, you can see here the RTI turns blue with 29 days till expiration. So you've sold the spread, and over time, you can buy back the spread for less money than what you initially received. So that's what a dragonfly looks like. And I believe that's the same, I think that's the same graph as the condor we just looked at. But anyway, so stick around here in just a few minutes. I'm going to show you really the best feature of all. That's our trade alerts. It's all part of what we're going to show you in the software solution we have for you. These are one-touch integrated with your trading account. So you'll receive a trade alert on your phone or email or on the platform, and you can just simply touch accept or reject. You don't have to try to translate anything and copy an alert that you might receive from an alert service and try to copy that. You just simply touch accept, and then our technology processes and places that order for you. So how would you even know where to begin and place a spread such as what I just showed you, especially the 4 or 6-legged spread? Which market are you going to trade? What strategy do you apply? At what price, or in other words, at what timing? And then once you have a trade on, what do you do with it? I think that's a big flaw in a lot of the mindset that maybe beginners might have, is they're really probably focused on where to get into a trade or position, and getting out of the trade is sort of a secondary thought at best. So we're going to show you how this all works with Theta Trader. Theta Trader is our technology solution that will pre-build option spreads for you with our proprietary algo. We create what's called theta trades each day. And then again, I'm going to show you that one-touch responsive trade alert technology. You can use bull, bear, flat market strategies, you name it, and then use automation with that risk thermal indicator. That's the color-coded risk and profit manager. That's all part of Theta Trader. Okay, so now that the preliminaries are over, let's jump into, let me switching screens here. Always takes just a moment. Okay, so we're good. As far as I can tell, you're looking at my Theta Trader screen. And in fact, if you could all comment with yes, that you can see my Theta Trader screen here, I want to make sure. And then I'll show you what this looks like here, and we'll go through this step by step. All right, great. So you'll see here, these are active trade alerts for the day, and I'll get back to that in a second. You'll see the theta trades for the day. You'll notice there are, well, let me skip down real quick. And then your open, short, or sold positions. Any short option spread or option here will be in red. And then any open or bought or long positions, essentially debit spreads here on the bottom, and then credit spreads above it. And you'll see the RTI in these different colors here. Green means good, yellow means slightly elevated risk, but do nothing. And I'll get into more detail there. And then here is your account information. It's integrated with your AltaVest trading account, and then any current quotes up there. So let's start out here. You'll see there are bullish strategies that are pre-populated, pre-built for us, and bearish, and neutral or non-directional. And we're trading and we're focusing on the E-mini S&P 500, mini NASDAQ 100, and mini Russell 2000. And the reason for that is liquidity and volume. So if you're going to be trading spreads, you want tight bid offer spreads on every option. And this is where you get the volume and liquidity that you need, especially on the E-mini S&P 500. So that's where we're focused. And I'll touch on that a little bit later. But you'll notice also gold. We have gold in here as well. And, part of the reason for that is we think it should be something you might consider having a bullish position in at times. And, gold made a new high late last year. It's pulled back since. But in any case, we like, for the most part, trading non-directional strategies on the E-mini S&P 500. That's our focus. And at least with Theta Trader, and that would be under the neutral strategy. And we looked at condors and dragonflies, so we'll go ahead and look at a couple here. You can see Theta Trader has built these trades for us today, different expirations, anywhere from 17 to 52 days till expiration, February out to March week 3. And you can see the strike prices are pre-selected here. And the profit potential, maximum profit potential for each trade, and then your targeted annualized return at expiration. And keep in mind, this number here is to compare one trade to another, that TAR number. It's not to suggest that if you place this trade here, you'll get 229% return on this trade. It just assumes that if you were to annualize this and it made the maximum profit, you did it every 17 days for a year, then that's the result. But of course, that's not realistic. We just have that there to compare one condor to another to give you perspective and context. So with that said, why don't we drill down further on this condor? And for demonstrations like that, I will simply just choose the trade, usually with the most days till expiration. So now it's pulling up the details on this particular trade. First thing I like to do is look at a chart. In fact, let me do this. If this helps zoom in a little bit, or maybe that's distracting, I don't know. But so here's the graph of what it looks like. So you can see the market trading along, and here we are now, and the algorithm has chosen this call spread to sell and this put spread to sell. Or you could look at just the calls alone or just the puts alone. And now let's look at the entire condor again. So this table will tell us all the details. I won't go into every single detail here at length, but you'll see the days till expiration, your expiration date, your settlement value, put risk, call risk, commissions, cash required, profit potential at expiration, targeted return on cash, and then your targeted annualized return. And then down here, you'll see, let me scroll down here, you'll see the puts that are being sold, the calls that are being sold, and then the long put and the long call that are used to hedge that position. And you'll notice that you could change the strike price, so you can modify the strike prices, but that sort of defeats the purpose of having the algorithm do it for you. But here's a question we get, so let me address it here. My mouse is kind of sticky here. Okay, so this has a cash requirement of $901, and your maximum profit potential is $99. Now, at first glance, you might think, well, I'm going to use $900 to make $100, and that's not a really efficient use of my cash or my margin. And why would I do that? Well, the reason you're doing that is the algorithm has looked at this and said, we're going to sell these puts here, and the delta is 9.97. That means there's over a 90% probability that this put that you're selling would expire out of the money. And looking at the calls, the delta is 6.87. So that's over a 93% probability that the call that's being sold would expire out of the money. So again, you're looking at those higher probability outcomes in terms of what the math is designating. And, it's not to say you're going to stay into this trade all the way through expiration. In fact, if you set up Theta Trader, and I'll show you how to automate it, but if you set it up to automate for you, you're always going to be out of these trades before expiration, whether it's for a win or a loss. All right, so you'll see the default setting is a sell. So you're selling the spread and collecting the premium. It always defaults to a quantity of 1, but if you want to do more or less, then of course, you see your cash required and profit potential goes up and down. So maybe you want to do 10 of them, so it's 9,000 cash required and $990 maximum profit potential, and your number here you're trying to collect is 2.4 points on each trade, and we'll go ahead and just place that order. And again, this is just a demo account, so you can see it assumes we're filled in the demo account. So that's just as really, that's just that simple. Let me scrunch this down just a notch. Okay, so that's an example of how to place a condor trade. Let's look at a dragonfly. Give it just a moment. Then I'm going to explain those color coding and also show you a simulator so we can go backwards in time. It's taking its sweet time here. I might have clicked the mouse too many times here, but if not, we'll just refresh the screen. Give it just a second. Here, let me just refresh that. And if not, if it doesn't come through, I'll just show you some of the trade simulations. I'm not sure why it's bogged down here. Well, what I'll do here is I'll just show you. Oh, there it goes. So Dragonfly, and I'll just again pick the one with the most days till expiration. And this is the E-mini S&P 500. You see the tab there. Must be a small glitch in the matrix here with my internet connection. All right. So here's what the Dragonfly looks like. Again, you're selling a quantity of 4 calls and 4 puts. And let me show you something here too. You can probably see it here. You notice the call that you buy here is 50 points closer to the money than the 4 that you're selling. And the same thing with the puts. You're selling these 4 puts, but the one put you buy is 50 points closer to the money. So what that does is it changes the whole dynamic and the risk reward profile of this trade in comparison to a condor. It becomes more risk averse, more I guess you could say less aggressive. And I'll show you how that manifests itself here on the table. So you'll notice same kind of data here, but your cash required goes up to 4,681, and that's because you're selling a quantity of 4 calls and 4 puts. Your maximum profit potential, of course, is higher because the quantity is greater. But your targeted annualized return compared to a condor of the same expiration is always going to be less compared to a condor of an equivalent expiration. And again, that's simply because you buy this option here, this blue line, this call, and you buy this put, and that's like buying additional insurance or having an additional hedge on your position. So that costs you money, but there are benefits for having that additional insurance. And I'll show you that in just a second. But again, the algorithm is choosing the strikes for you. It's building the trade for you. And the quantity defaults to 1. If you wanted to do 2 of these or 3 of these, you can see the cash required moves up, profit potential moves up. And again, you could always change the strike prices if you wanted, but I would recommend not doing that. And you can see the delta here of 9.51, so over a 90% probability that the puts that are being sold will expire out of the money. And then the calls here, 6.37 delta, so over 93% probability that those calls being sold will expire out of the money. And we'll go ahead and place these, we'll sell 3 of these, try to get just over 8 points. And there you go, shows up right here as being filled. If it were for real, of course, the order has to get filled. But if it were filled, this is how it shows up on your dashboard. Okay, so let me show you here one of the best features of all. I'm going to say that probably 2 or 3 times because there's some really great features. Here is the trade simulator, right? Let's see where it is here. Okay, so you can go backwards in time. You can pick any date you want. In fact, let me show you how to do that. It's right under this menu here, Trade Simulator. But I've loaded some to save some time. And what we'll do, I'll squeeze down the screen so you can see it better. So here's a January week 3 RN Condor, and you can use these buttons to play. So we're kind of going backwards in time to see how this trade would have worked out. So you can go a step at a time here, forward, or play it, or you can go all the way to the end at once, or all the way. And we'll just kind of go step by step, and I'll show you what's happening. So you see day by day, the RTI is green. That means do nothing. You can see the trade, the P&L here is slightly negative, but getting positive. So not a whole lot happening, which is what you want with a condor. Now the trade's getting more profitable. And then it turns blue, and that says take your profit and move on to the next trade. And that's well before the expiration date here. So that's kind of what I mentioned. We're always going to be out before expiration. But here's the signal, and you can automate this so that you don't have to monitor it. And I'll show you how to automate that. It's just a setting on the account. But the algorithm said that's enough profit in return for the risk and in relation to the time and some other variables, of course. But get out of the trade, take your money, and go on to the next trade. And that is the week 3 January Condor. So here's the week 3 Dragonfly, and I'll just go to the end to save some time. And you can see same kind of result. Ended up taking a profit here. P&L looks good, and let's see, that was on, what's the date here? December 23rd. So right around here was the profit for this particular dragonfly. And let me compare it. Yeah, same date, happened to be the same date on the condor. Now let me show you when the dragonfly can really pay dividends. So here's a condor, and we'll run through it here. Kind of fun to watch this play. It's a useful thing to do and kind of a fun tool, but you can see it's turning yellow. Elevated risk, but do nothing. You can see why. It's getting closer to that upper boundary, but still do nothing. And it's trade's profitable, so it's okay, but risk is getting elevated now. You're losing a little bit of money on the trade, and then it turns red. That means too much risk, and you need to get out of the trade. So you can automate it when it also turns red. So that's the July week 2 condor ended up with a losing trade. Now let's look at the dragonfly. And it's the same expiration, July week 2. So you could place a dragonfly on the same day as the condor with the same exact trade, and let's look at the difference. So you get yellow RTI, just like on the condor. Getting better, and now look at this. It turns blue, so you get a profit-taking signal with 15 days till expiration. So you're out of the trade here, but look at the condor with 15 days till expiration. Right around here, it was profitable, but it hadn't reached a blue yet. So you ended up staying in the condor and taking a loss, but had you been in the dragonfly, that trade at that time, of course, would have worked out and done better than the condor. And that's because you own this blue line here, which is this call, the 5625 call. And what happens then is the delta is more sensitive to the underlying, or the delta just is higher. So as the market's moving closer and closer to this strike price, it's gaining in value more rapidly than the others that you sold, and you own it. So it's gaining in value more rapidly because the delta is higher, and conversely, also it doesn't lose as much time or theta decay because the delta is higher. So that's the big benefit, and I'll show you another example. Here's a condor, and it ends up being a profitable trade, but you had to stay in it until there were 3 days till expiration. And we'll look at the same expiration. Instead of a condor, we do a dragonfly. And look at that. You got out with the dragonfly signal here, and 11 days till expiration. It turned blue right here. So oftentimes a dragonfly will give you a chance to get out earlier compared to a condor, or as we saw here, it may actually even keep you out of a losing position compared to the condor. So those are the big benefits to the dragonfly, and we like doing these a lot. And not to say we don't do condors, but they're just different. They have different characteristics. And let me show you here, before we jump into that, there's a help file here under the account settings, under help, and there's a glossary, and you can see how the RTI is all explained here, all the color coding. There's also definitions for all the different strategies here. So that's all under the account settings here for your account. There's also videos. There are tutorials here on how to place all the different trades that we looked at, but it's really just as simple as what you saw. And there's education videos as well. So I wanted to point that out here while I'm on that page. And now let me show you what I think is probably the best feature of all. Let me go back here, and you'll see here you have a trade alert that's active, and you would click view, and then it takes you right to the trade alert page for that active alert. And here's an explanation. This is an April week 1 S&P 500 Dragonfly spread. The goal is for the S&P to stay between those sold strikes, and that's the red line here and the red line here, and then exit the position automatically prior to expiration using Theta Trader's profit directive. And what you can do here is you can change the quantity. If you want to do fewer dragonflies, you can, but you cannot increase the risk or add to the position, but you can decrease it. So we'll go ahead and do 8 of these here. You can see the trades explained right here. The price is all done for you. The premium being collected, the cash required, 66 days till expiration, and it's awaiting a response. So all you have to do is, if you're on your dashboard, touch accept or reject. And also the alerts come to your phone and email, and I'll show you that as well. But you can go ahead and just touch accept, and that's it. It's just that simple. It shows that your trade is filled, of course, in the demo account. Also wanted to point out under positions, you can look at all your, of course, your open short positions on the dashboard, your open bot positions, or you can go backwards in time, look at your closed positions here. And this is what it might look like. You can filter for anything you want, but I just have everything here, 20 on a page, and it shows you 20 trades, 16 winners, 4 losers. There's the profit on these trades. Now, again, this is a demo account. Don't make too much of the results one way or another, but this does make sense that you have 12 short spreads or short positions. So 12 were winners and 0 were losers, and you had 8 long bot spreads or debit spreads and 4 winners and 4 losers. So you can see even in the demo account, the higher probability of these short or sold spreads working coming into play. So anytime you're selling, collecting premium like that with these deep out of the money options that are being sold, um, you have a much higher probability of a successful trade compared to just buying options. But if you want to look at any particular trade, you just click on it and highlight it. You can see the gray bar there highlighted, and you scroll down and you can see here what this trade looked like. And placed on December 4th with 45 days till expiration. It was negative for a while, and then it theta decay started to work. Came into a little bit of trouble, but still the algorithm said don't do anything. And then it got more mature here, and then it turned into a profit, and you were able to close that one out and move on. So that's how you look at your closed positions. And you can also do something called Trade Builder and build your own trade if you wanted to, but I don't really recommend it, but it is there. Some people do use it. And let me show you here. We have something called under the My Account menu, something called Trade Scope. That's our daily research, proprietary and available only for clients. Helps you position your spreads with some analysis there. Looks like the Fed was it 98%, 98.4% chance of no rate change, which have turned out to be the case today. But that's available to you only for Theta Trader members and clients. We have our daily trading commentary, and you can see here a review of what's happening overseas in Asia and Europe and in the US, and then looking ahead, and then anything on the economic calendar as well. So that's just one page, and people like the convenience of that quite a bit. And then this is what you do. Under My Account, you go to Settings, and you can see here, you can check all the different things that you want to receive the alerts via email or text alerts via your trade alerts via email or phone. And then this is how you activate the risk manager. You just check the box, and you'll notice the default level here was red, as we saw. And if you want to change it, you can. If you want to go to a lower risk threshold or a threshold or level, you can go down to say 38, or you could go and use a custom level and go anywhere from 25 to 50. But remember, if you lower the level here, you're going to have more frequent losing trades, but each losing trade will be probably less in magnitude or a dollar amount. So that's the trade-off there. I just like to use the default setting that's sort of been back tested over many years, and we think that works best. And this is how you do the profit directive. You just check the box, and then when you're done, you just save your settings here, and that's all you have to do, and then everything is automated. So you get to see you just had a view of the simulator and the trade alerts, and also the various theta trades and how easy it is to use those theta trades. And we mentioned these neutral strategies. But keep in mind, you can be bearish. You can sell call spreads. You can buy put spreads if you want. Um, there's gold here. If you were bullish on gold, there's some call spreads to consider. So it's not just one dimensional, but it does take the heavy lifting out of the idea of trying to fabricate and build your own spreads with up to 6 different legs, which could be kind of a big undertaking. All right, so I think I've covered a lot of ground there, and I want to show you really the best feature of all. I said it again, but I think it's the trade alerts by phone. And let me switch gears here, and then keep your comments and questions coming to. I may not be able to get to everything right this second, but we're gonna have time. So I think I covered everything on this page that I wanted to. Let me just double check here. And if there's anything else, yeah, I covered all this. So I think we've covered a lot of ground. Let me switch gears. So just a second, folks. So we're going to show you just a brief video here on what it looks like on your phone. When you receive these one-touch responsive trade alerts, all you simply do is touch accept or reject on your phone. And again, these alerts are live, meaning they're integrated with your AltaVest trading account. So all you do is touch accept and place the order. So here's what it looks like when you receive a text message. And then it'll pull up the screen for the actual alert. And you can see you get a description of the trade up here, days till expiration, in this case 52. This happens to be a dragonfly, so you get a graph, and you'll see there's a quantity of 9 pre-selected, and every alert you receive is going to be unique and specific to your account. It will not be an overlapping trade that you might already have on in terms of strike prices or expiration. And also the quantity will be sized and custom and tailored for you and your account based on your account balance and your available cash and so forth. So this is all pre-selected and automated for you. But I think I did show you that you can reduce the quantity if you want to take a little bit of the quantity off the table. And you can see here the premium being collected, the cash required, the premium that you're trying to collect, 7.85 points or higher on this particular trade. See the quantity there. Days till expiration. So it's all there. And if you like what you see, just touch accept and then takes you to your orders, and that's it. So I'll run through it one more time, but people really love the convenience of these trade alerts, especially with their mobile device. If anyone has any questions on that, feel free to shoot them through. But I think it's fairly self-explanatory. So it could be a condor, an alert, it could dragon, it could be a call spread, a put spread, it could be a long put spread, it could be a gold option trade. But mostly we're looking at the E-minis and short option spreads. All right, folks. Oh, there it goes. I think I mistakenly paused it. But that's what it looks like when you receive an alert on your mobile or your phone. And you can just highlight that field where it says quantity. You can always reduce the quantity if you'd like. And if you don't want to accept the alert, you just touch reject, and that's all you have to do. Okay, so here's how to get involved. And this is for a lifetime membership is what we call it, a Theta Trader lifetime membership. And that includes everything that we just demonstrated with Theta Trader, all of the software, all of that functionality with your Theta trades. Those are pre-generated spreads. The risk thermal indicator, that's the automation, risk and profit, color-coded. And then the trade simulator, so you can go backwards in time and use those tools at the bottom to go forwards and backwards and test any particular strategy at any particular point in time. that value there over $3,500. And remember too, these trade alerts, everything you saw about the trade alerts, that's all part of Theta Trader. Each trade is custom for you and your account, and they're integrated with your account, these alerts. So all you do is touch accept. And then once a trade is filled, whether you use an alert or you place the trade yourself on the dashboard, it doesn't matter. You could have the RTI automatically manage it for you. You saw how to just set that up so you can just automate the profit and the risk controls. So Theta Trader includes everything we just saw, valued at over $8,000. But I think what really makes it stand apart is us. You have real people talking to you, private coaching. We'll do screen sharing sessions. We can use, I think we use Zoom and GoToMeeting. So everyone here is licensed and experienced with decades of experience, and we'll do a screen sharing session with you if you need to talk to us about trade setups or any questions on the software or the platform. That's all part of your experience here. You have a co-pilot, someone to work with. You can discuss history, strategy, moving forward, looking backwards, whatever it is you want to do. So we are available. That's part of what you're paying for here and what you're getting with Theta Trader, valued at over $7,500, having that training there available to you. So you have the software, the alerts, and the private coaching, valued at over $15,500. But I don't want you to forget, you have the proprietary research, TradeScope, and our daily commentary. And really, in probably 5 minutes, it's all you'll need to do when you run through these. It's just really one or two pages each day, but we make it digestible. And then you have those online tutorials. I briefly showed you about where to find those under your settings. So anything you need on Theta Trader or even strategy or trade structure is available. So again, it's a lifetime membership. Everything we just saw, valued at over $18,500. But no, of course, that's kind of corny, but we're not going to charge you that or this. In fact, this is what we did charge in live in-person events. And of course, we're doing this by webinar, and we do that mostly now these days since the pandemic. And then we had it at $997, but we work with Timing Research here now for a while, and David is kind enough to have us back. So this is really our lowest price ever. And that's the link there, $497. That's your lifetime membership. cf.altivest.com/TR for Timing Research. That's my direct phone number and email if you want to reach out to me and have any questions. It does expire Friday night, that special offer. And just one page and click the button and you are a member. If you're looking for a free membership, we'll rebate that amount to you if you have $100,000 or more in your account in the next month. Or if you have $25,000 up to $100,000, you'll get 50% of that membership rebated. And there's also a guarantee. So 30-day money back guarantee on that. You sign up and something happens and you just can't move forward, that's fine. Let us know. We'll just refund you the membership fee. And then a few FAQs. Tax efficiency, yes, futures and options are tax efficient. And here's an example compared to trading stock options. You can save over $2,000 in this example. And that's because 60% of the gains when you're trading futures options, those are taxed at the typically lower capital gains rate. So there's a big tax efficiency advantage here. And then there's no more itemizing. You just get a 1099 on your P&L. You don't have a big pile of papers swallowing you, trying to go through wash sales and all that stuff. So big advantage, but do consult your tax attorney and advisor. IRA, yes, we have IRAs transfer all the time. We can do that. And then again, why the E-minis? Well, they're liquid, they're efficient, and they're cost effective. Densely packed strike prices, 100 annual expirations, and ensure granularity and coverage. That's according to the CME Group. And they have a white paper that says their products offer superior execution compared to SPX options, $4 to $15 per contract savings just because of the tighter bid offer spreads. So that's what we're looking for, and that's why we're in this particular space. Uh, and these options offer deep liquidity, a wide array of maturities. So what that means is you have some calls and puts here on a dragon or a condor, and then as time goes by, uh, the algorithm is looking for another set of calls and puts to trade, and then another set of calls and puts. And as it's looking, it needs the volume and liquidity to be there. So it's going to find what it needs uh, when you're in the E-minis. And then the big advantage with Theta Trader, and I hinted at it earlier, is when you're doing a dragonfly, it's done as one order at one trade at one price. You don't leg in. Do not ever try to leg into these spreads. It'll end up backfiring on you at some point, probably sooner than you hope. If you're doing this with stocks and trying to do a dragonfly, I've tried it on several platforms, the big ones, and I have not seen how to do it. 6 legs as one order. They always have to break it up and leg into 2 separate orders and then leg out. And it's just not, I don't know, it's just not effective. Let's put it that way. So you have immediate access to sophisticated option strategies using Theta Trader. Remember, rookies are the ones that just only buy options. That's because time or theta is against you. It's a good video here on YouTube if you want to look that one up. But she here on CNBC says what I'm kind of referring to here. The appeal for retail investors to buy options is that they're cheaper, but your potential for profit is actually not that high. And that's because they typically expire worthless. 2021, 11% of Robinhood active users made an options trade, but of that, fewer than 1% actually made options spread trades. So we're trading spreads for the most part. It's not to say we don't sometimes buy or do a debit spread, but in any case, so there's other advantages too in trading the E-minis. Why not just trade 1 or 2 markets instead of, what is it, 6,000 symbols and securities? Efficient margin, clear cost structure, nothing's hidden. Everything trades at the CME group on their electronic exchange. Every order is treated equally. There's none of that payment for order flow stuff where you feel like you're getting a free trade, but everything's commission free, but your orders are actually executed at prices inferior. So everything here with us is transparent. Your commissions are 5.25 round turn, and that's all inclusive. That includes everything. Here's a big box brokerage firm I just looked at this month. They have a rate published at 2.25, but you look at the details and it's per side, and then they add more fees on top. And you can see it does not include NFA fees, clearing exchange fees, ends up being higher than what we charge. So our option commissions are competitive, and performance, everyone's different because everyone uses it differently. It's self-directed for self-directed traders, just like any brokerage firm. Everyone ends up with different results. And reminder too, everything is net of all trading costs. I should have pointed that out earlier. And different account types. I mentioned IRA, individual, joint, corporate, LLC, trust, all the usual. And then why would you want to consider Theta Trader? Well, it's really an alternative because it has low correlation to any traditional asset class, and it might improve your diversification, lower portfolio risk. And you think, well, what's the risk? Well, first of all, how about inflation? This is kind of shocking when you look at it, but since 1971, since we removed from the gold standard, dollar has lost 99% of its value. It's kind of crazy to think of that. Here's your $1 million dream house. That's what it used to look like as a kid. And here's what it looks like now. Kind of a cracker box. And so that inflation shark is, it's always with us. This gentleman here says inflation long term is 4 to 5% each year. I think he's right. So Theta Trader is an alternative solution. It's a low correlation to traditional assets. Absolute return is what they call it in sort of hedge fund speak. So some of the benefits, just to review: strategies for any market condition, wide margin of error on these spreads, convenience with the automation, diversify with non-correlated strategies, and then those one-touch responsive trade alerts, strategies for bull, bear, conditions, non-directional. We're not day trading. We're not stock picking. We're not trying to trade the chop. This made me laugh, so I put it in there. According to my calculations, the stock market will fluctuate. So no, we're not doing that. And we like the wide margin for error. You can see, like in this example on the Dragon, over 1,100 points between the short calls and the short puts. And we think it's a time saver. Here's someone saying they can market trades. The market consumes 10 to 12 hours of my day. I don't think most of us have time for that. It's a diversification tool. Again, these are alternative strategies, mostly non-correlated to the benchmarks. So absolute return possibilities. What that means is we're not always looking for a bull market. We don't just buy a bull market and hope something goes up. We can be non-directional. You can be moderately bullish, bearish. It doesn't matter. Strategies for any condition. We like the portfolio 3, where you have a slice of what you're doing into something like Theta Trader with an alternative approach. Keep in mind, S&P 500 valuations are stretched. I mean, I know everyone's talking about that forever, and broken clocks, I guess, correct twice a day, but we are at historical peaks based on the valuation measures like PE, the CAPE, the market cap to GDP ratio. We're at historical extremes, reaching prior peaks. So here's where we are now. We've never been this high based on these traditional valuation measures. This graph here I pulled, and this was kind of interesting. We're at record low household income expectations right now. That's kind of shocking. And employment expectations are plummeting. So keep that in mind, folks. I don't know if we're going to hit a rough patch here soon, but this was interesting too. Just Monday, the S&P was down negative 1.5%, yet the breadth was positive. And that's only happened 3 times before, and that was during the dot-com bubble. So that's kind of a crazy thing. But then the very next day, which is yesterday, 70% of the S&P was down, yet the index was up strong. And that's because 10%, or I mean, not 10%, 10 of the mega caps added 60% to the gains. And NVIDIA was almost 27% of the gains. So there's just this market structure now that's very distorted and dislocated. This is from December 31st. I think that pie's shifted, well, probably got even a little worse. So probably got close to 40%, but maybe it's back down close to 34% now. But you get the idea. If you're not in those big 7 stocks, you're probably struggling. If you're like in a weighted index, and here are the top 5 stocks here as a percentage of the S&P. So way beyond all records. So, and keep in mind too, market drawdowns can last for decades. You can see these areas here where they're highlighted. It's hard to tell on the chart, but this can be 20 years if you happen to end up buying at the wrong time. Like, for example, you buy here at the dot-com bubble near the top. I don't think you recovered for at least 15 years. So the point is not that we don't want you to, we're not financial advisors, but not that we're suggesting you can never buy stocks or own stocks or whatever, but keep in mind that just buying stocks and sitting on them and being passive all the time, while it can work, there are periods of time where it definitely does not work. So diversify with alternatives. We like these automated, unique option strategies. You can use them to speculate or hedge your stock portfolio. And those one-touch responsive trade alerts, people love those as a tool. You just touch the green button, and this is what it looks like when you receive email. You just click that link, takes you right to your dashboard, and you saw what it looks like on the dashboard here. And then this is what it looks like on your phone. And then it takes you right to the screen, and you just touch accept. You can lower the quantity if you want, and then, or just reject if you don't want to place that trade that day. So again, Theta Trader membership, it's lifetime. Everything you've seen today, including personal coaching. If you complete that order form, you'll get your login credentials. You'll receive an email with a link on how to open your account. And then once your account is open, you'll fund it, and then you can begin trading and accepting the alerts. And those are the algo-driven options trades. Hopefully it'll help you control your emotions. That's really kind of I guess you could say, the catalyst for creating Theta Trader was having clients over the years. And us too, we're all people, we're all human. We let our emotions kind of get the best of us when it comes to trading. So Theta Trader can help you with that. Whether the strategies are bullish or bearish or non-directional, doesn't matter. You've got that trade simulator to go backwards in time. You can use that. So there you have it, folks. And I think I see a few questions. We're not trading stocks. So yeah, sorry about that. And what size account? Minimum is 25,000 that we suggest. Or you can call me and tell me what you're up to. But if you want to get the rebates, anything 25 to 99,999 gets you a rebate of some kind. And how much should I have in my account? Want to give me a recommendation? Yeah, 50,000 is probably a good recommendation because each dragonfly, as you saw, is about 5,000 for the margin. So if you want to have several different dragonflies going simultaneously at different expirations and then kind of rounding it out with some other condors and other strategies, 50,000 would be good. Yeah, any type of IRA we can do. And which email can I use to ask about your services? Well, just call me or email me. You see my email right on the screen there. And someone's asking about the performance. Again, everyone's performance is different because everyone trades it their own way. These are not managed accounts. We are a brokerage firm, and this is a trading tool we develop for our clients. So some people accept alerts, other people don't. Other people change them. Other people can't accept them because of the size of their account or what have you. So everyone's different. There is a 30-day guarantee. That's correct. And see if there's any other trades coming in, or I'm sorry, not trades, but any other questions or comments, or if there's any other thing I have in mind that I might have missed. Give me just a second here. I think I did cover it. If there's any other questions, put them in the chat. Take a picture of the screen there and feel free to contact me. And if you want to get on board with that special offer, it is available through Friday night. So you do have a moment if you want to call me or ask me any questions via email ahead of time. That's okay too. Is there a broker? We are the brokerage firm, AltaVest. We are a brokerage firm since 1997. So this is our technology that we developed for our clients. So to use Theta Trader, you become a client of AltaVest and open an account with us. So sorry if I didn't make that clear, but good question. People ask about Canada, so I'll address that too. You have to have basically a legal U.S. residence address. So if you're in Canada, unfortunately, we probably can't work with you, or if you're in the EU, probably not as well. But we have clients in Down Under and Oz, and believe it or not, parts of it's easier to open an account in parts of Asia compared to Canada, which is crazy. But it has nothing to do with us. That's just regulations and compliance that's way out of our control. But we'd love to have you on board if you were Canadian. Yes, we are the brokerage firm. AltaVest is a brokerage firm. We're the introducing brokerage firm, not securities. This is futures. So you trade your monies with a futures clearing merchant, or FCM. So they have custody of your funds. And then we basically have the account on our books and you place your trades through us. So RJ O'Brien is the FCM that we utilize. Have been doing it for over 100 years. They're located in Chicago. Does that answer the question you asked, Omar, I believe? Does that help you out? Yeah. Good question, though. Yeah, we don't maintain custody of your funds. That's the clearing firm does that. And every account is a separately managed account. So it's in your name. money comes and goes in your name only, in your account name. So we don't have any input on that or anything. We're just know you have an account and you're placing trades, and that's kind of the relationship there. All right, folks. I guess there's nothing else. Maybe the next person gets started a few minutes earlier. So I'm all set. Thanks, David.